Hello everyone, my name is Saldi Owen Simbolon. I'm an accounting student from North Sumatra University, and today I'm going to explain to you a little bit about accounting for partnership or firm formation. So let's get started. Firm formation. There are two types of firm formation. The first one is new firm. On a new firm, all prospective members or partners deposit assets with the firm, which will be recognized as the initial investment recorded in the partner's capital account. The sped-up assets must be valued at their fair value, then recorded as an investment partner, which will be wound up. The journal credit. So here we need to put all the assets, like cash, inventories, buildings, and others, on debit, and credit all the partners' capital. From the journal entries that have been made, the firm's initial balance sheet will then be prepared as of the date of establishment. Cash example. On March 1st, 2019, Adi, Ari, and Andi were three friends who wanted to form a new firm that would be named the 3As. They agreed to deposit assets at value as follows. Here are the types of assets we have cash, land, office building, and vehicle. Adi's cash is 35 million, Ari's is 10 million, Andi has no cash. Adi has land with fair value 325 million, office building with fair value 50 million, and Andi has a vehicle amounting to 25 million. Now we asked to make the journal entries needed to record the formation of the 3S firm and make a balance as of the formation. Here's the journal. Date the 1st of March 2019. The description, like I said before, we put all the assets on debit. In this case we have cash, land, building, and vehicle, and credit all of their capitals as the number. Then the initial trial balance at the date of the establishment. 3S firm, March 1st, 2019. All the assets on the left side, cash, land, building, vehicle, and all equities on the right side. Here we write the number we got from the journal before, like cash 45 million, land 325 million, land 225 million, and so on. Let's move on to the second type of firm formation. The firm was previously established as an individual company. If the firm to be established has previously owned an individual business, then the business will be merged into a new firm by means of raises odd business assets and over odd business assets to the firm and from the firm. If during the revaluation of assets there is a greater difference between fair value and book value, the difference will be recorded as goodwill. There are two accounting methods we can use for recording the merger. The first one is continuing the old book. The second is opening a new book. For continuing the old book, in this method, the newly formed firm will continue its records by using the book of one of the assigned allies. The recording procedure includes the following: adjusting assets, debt and equity, recording deposits of members who do not have odd businesses, and prepare the firm's initial balance sheet. Another case example, Love Company, owned by Ariel, which initial balance sheet as of April 1st, 2019, shows the following position. Love Company, balance sheet, the 1st of April 2019, current assets and fixed assets, 50 million and 100 million, and liabilities and equity, 20 million and 130 million. On that date, two of his friends, Budi and Tata, agreed to establish a new firm called ABC Firm and agreed to adjust Love Company's assets as follows. Account receivable removed by 5 million, inventory added 10 million, fixed assets added into 125 million, and goodwill for Ariel is 40 million. For this establishment, Budi deposited cash in the amount of 100 million, and Chacha deposited current assets in the form of inventories and fixed assets amounting to 50 million and 100 million. And now we are being asked, by using both methods of accounting for the establishment of the firm, compile the journal entries required to record Ariel's asset adjustment, the journal entries required to record the formation of the ABC firm, and make a balance sheet as of the date of establishment of the ABC firm. So here's the journal if Ariel's book is continued. First, we need to make the assets adjustment. We put the inventory, fixed assets, and goodwill on debit, and credit the account receivable and Ariel's capital, 70 million. And for the 70 million, this 70 million comes from the difference between this asset and the account receivable. So we edit all the assets, 10 million plus 25 million plus 40 million, subtract 5 million from the account receivable. And here we get the 70 million. Then there's no journal for closing Ariel's book because we are continuing his book. So forming a new firm, I put cash, inventory, fixed assets on debit, and credit Budi and Chacha's capitals. So we're basically recording Budi and Chacha's deposits here. And this is the journal if they decided to open a new book. Same like before, first we make the adjustment. Exactly same like before, inventory, fixed assets, goodwill, and credit, account receivable are in Ariel's capital. But for this one, we need to make a journal for closing Ariel's book. So we put Ariel's capital and his liability on debit, 200 million and 20 million, and credit all his current assets, fixed assets, and goodwill. Sorry, there's a typo here. And forming a new firm. Put cash, current assets, inventory, fixed assets, and goodwill, debit, and credit all of their capitals and their liability. This is the number. And balance sheet of the ABC firm. ABC firm balance sheet the 1st of April 2019. All the assets on the left side, cash, current assets, fixed assets, and goodwill. And all the liabilities and equities on credit. Liability 20 million. Ariel's equity or his capital 200 million. Budi's 100 million. Chacha's 450 million. With total for each both 470 million. Okay, that's all I think for my video. Thanks for watching, and don't forget to comment and give a critics or suggestion. And if you have any question, please feel free to leave it on the comment section below. Hopefully I can answer it as soon as possible. So once again, thank you. Thanks a lot.